So a few weeks ago, I made a video about why nurses in the US are broke, which generated a ton of reactions. One of the reactions that stood out was this comment by a lady in the comment section, and it says, "Great content. It would be nice if you can do a video about different types of investments that nurses can do, especially for us nurses who don't have enough information about investing or financial literacy." And so as a direct response to this comment, I decided to make a video about 5 investment opportunities for beginners. And this is applicable to you whether you're in the US or you're in the UK, even though some of the names may change, but broadly the principle of investments are very identical and similar. And before I proceed, let me say that I'm not an investment advisor, and the information I'm sharing in this video is from my own research, my personal experience, watching copious amounts of YouTube videos, and reading information on credible websites like Forbes and Time, which has information that is available to the general public and anyone who is interested in improving their knowledge in the financial markets. And so please be sure to consult the services of a financial advisor or a certified public accountant if you wish to make a decision based on the information you are getting in this video. The first and probably the most popular investment instrument is index funds. So index funds basically look for a market of companies to invest your money into. So instead of having your money invested in one company, an index fund will look for a market, say the healthcare market or the tech market, and invest your money in that market. And so it forms an index, which is more like a list of the best performing companies, and then invest your money there. And one of these index funds is the S&P 500, which is easily the most popular index fund in the US, if not in the world. It's been around for such a long time, for well over 60 years, from March 4th, 1957 up till date. And it's called S&P 500 simply for the fact that it was started by Standard & Poor's Financial Services LLC. And this type of index funds itemizes the 500 best performing companies across several markets here in the US. So the S&P 500 will invest your money in 500 best performing companies. It has formed an index of 500 best performing companies here in the US across industries like technology, healthcare, financial services, consumer services, and to invest your money in all these companies, which are the biggest performing companies here in the US. And the good thing is that the S&P 500 is tied against the performance of the US economy, which is why some people feel like it's the most reliable investment, because it also shows, apart from the S&P 500 just having its own performance, it is a direct reflection of the performance of the US economy. So if you feel like the US economy is going to go up, then you can rest assured that the S&P 500 is going to go up, because the companies that form the chunk of the US economy is what the S&P 500 is investing in, which is why a lot of seasoned investors recommend the S&P 500. For example, Warren Buffett is on record to have said that keep buying the S&P 500 through thick and thin, and especially through thin. And if you know Warren Buffett, who's one of the wealthiest and most respected investors on the planet, worth over $100 billion, recommending the S&P 500, then you know it is one investment instrument you need to take really serious. Now, another interesting fact about the S&P 500 is that over the past 60 years, which it has existed as an index fund, the average return on the S&P 500 has been 10%. And there are some years that it has gone higher than 10%. There are some years it has gone as low as minus 30%. But over the 60-year period, if you left your money from the time it was started up till now and you calculated it, you realize that the average return per year is 10%. Now, I know that nobody can predict the future, but if past performance is an indication of what's going to happen in the future, then let's do a simple analysis of what your money would be if you invested an amount in the S&P 500, judging by the fact that it's had a 10% year-on-year return over the past 60 years. Let's just say you want to start investing with any amount. Let's just say $5,000. And I'm using $5,000 because I know that here in the US, as a nurse, most hiring companies or most recruiters will give you a $5,000 sign-on bonus or $10,000 sign-on bonus. And for even internationally educated nurses migrating to the US, companies like AMN are giving people $5,000 on signing with them and migrating to the US. So let's just say you get your $5,000 and you decide to invest that money in the S&P 500. Okay, let's see how much you are going to get after a 10-year period. Let's go to a compound interest calculator and let's go to investor.gov, which is like the government one. You are investing, let's say $5,000 for even a conservative investor who is not interested in adding any extra money, but they are just investing $5,000, and they have a monthly contribution of, say, let's just say every month you put $200 aside for your investment, and then you are doing this for 10 years, okay? And the returns is 10, and interest rate variance rate, we can leave that out. But the compound frequency, how often do you want it to be compounded? Let's say you want it to be compounded annually every year after the end of the period, you go on. Now then we click calculate. It's going to tell you the amount you're going to get. Okay, now you can see that in just 10 years you are getting $51,000 after investing $5,200 every month. That is $100 per paycheck, and this is unbelievable. Another amount, let's say you are a more aggressive investor, and so you want to invest, say, $10,000, okay, and every month you invest $500 into an investment account and you leave it for, let's say, 20 years. So you are using this amount of money to build a retirement account. So let's just calculate that and see. The amount you get in 20 years, you will have $410,925,000. Guys, that's nearly $500,000. Now that is just for investing in the S&P 500 alone. If you have other investments, you are nearly going to be getting $500,000 just from investing for 20 years. And assuming you are in your early to mid 30s like myself, in 20 years time when you'll be 50 and you want to be retiring, you can have $500,000 in your account just by investing $500 after your initial investment of $10,000. I think this is a good thing, and this wonderful performance leads credence to why people like Warren Buffett have said that just focus on investing in the S&P 500 and forget about all the other rubbish, in quotes, as he says, out there. And if you wanted to invest in the S&P 500, a lot of financial companies give you the opportunity to do so, like Fidelity, like Vanguard, both here and in the UK, like Schwab's, like JP Morgan Wealth Management, and so on and so forth. You can just go online and open an account with any of these companies, and your investment journey has just begun. That's quite easy and straightforward. And so I think we've said enough about the S&P 500. Let's go on to the second investment option. The second investment instrument is a 401k. Now, the first time I heard of 401k, I was quite surprised, and I was wondering what's the meaning of all this 401k. But in simple terms, the 401k is just a retirement account that comes from your employer. So what happens in the 401k is that your employer decides to hold back a portion of your income. So before they pay you the income that you have your taxes deducted, they will hold back, say, $500 or $1,000 from your amount from your paycheck before you are taxed. So what the employer does is that they will hold back a percentage of your paycheck, and let's say they'll hold back $500 or $1,000 every month before your tax is paid. And I know that now there's even a type of 401k that you can do after your tax is paid. If you invest in a 401k that is deducted before tax is paid, remember that in retirement, when you are getting that lump sum paid to you, you're going to pay taxes on that amount. But if you pay tax already, you are not going to pay any taxes on that amount. Now, the good thing about the 401k is that the amount you decide to pay, which means that the amount you decide to be deducted from your income, whether it's pre-tax or after tax, your employer is going to match that amount by a certain amount or by a certain percentage. So let's just say your annual earnings is $100,000 and you decide to pay about, let's say, 10% of that amount into your 401k. What that means is that your employer is also obliged to contribute about 10% of the amount you are paying to support your 401k. And so it comes as some free money that is coming from your employer to support you just because you have a 401k investment. Now, the other thing is that some people are not focused on their 401k, so they do not maximize it. But the best thing is that you maximize the amount you can contribute in your 401k so that your employer is also mandated or obliged to support you with that contribution. And it's money that you are going to get at the time of your retirement, and it's going to be a wonderful opportunity for you to raise a huge sum of money for your retirement. The third financial instrument you can invest in is what is called a Roth IRA. Now, a Roth IRA is basically a Roth independent retirement account. And for people who don't have their employer giving them a 401k, they can have an independent retirement account. Now, the good thing about a Roth IRA is that it is money you are investing after taxes. And so when it is due for you to withdraw at the time of retirement, you are going to withdraw that money without any taxes or without any penalty. Now, there are several companies like Fidelity, Schwab's, Vanguard here in the US and in the UK. Now, last year, I understand that the investment threshold was $6,500 per year. And for you to be qualified to invest in a Roth IRA, you must be earning under $140,000 as an individual, or under $240,000 as a family of two. And so for nurses who are planning to go into other specializations like nurse practitioner or CRNA and jump up their incomes about $140,000, this is the best time to start investing in your Roth IRA. Of course, there will be other investment opportunities for you, but for the Roth IRA in particular, you will not be able to invest in once you exceed that threshold of $140,000. The interesting thing about the Roth IRA is also that when you are due to buy a house, it allows you to take out up to about $10,000 of the cash to serve as a down payment for a home without any penalty. This is similar for a lifetime ISA account in the UK, where the government supports you with about 25% of your deposit to buy a home back in the UK. Here in the US, you're able to withdraw some of the money to serve as a down payment without penalty for a home. And so for people who have interest in buying a home, one of the first things that you can consider, or one of the best investment instruments that you consider for you to be able to use down the line, is a Roth IRA. They invest your money in several investment market options like stocks, bonds, and so on and so forth. And that takes me to the fourth one, which is a high yield savings account. So what is a high yield savings account, also called the HYSA? It's just a different type of savings account, but it's similar to your traditional savings account. The only difference is that it gives you a higher yield, because traditional savings account, like say you open a Chase Bank account or a Wells Fargo account or a Barclays account, you're going to get about 1%. I mean, here in the US, some of them give you about 0.5% interest on your money per annum. Okay, so if you leave $10,000, by the time the year ends, you would have earned just about 0.5%. Meanwhile, inflation is way higher than that. Okay, so your money is going to lose value by the time the year ends, which is why the idea of a high yield savings account is very good. High yield savings account typically gives you interest rates between 4 to 6%, and so you can get a lot of returns on your money. Now, the other thing is that if you want high returns on your money but you're nervous about investing in things that I spoke about like the S&P 500 and the rest, then a high yield savings account will be a good option for you, because it gives you easy access to your money anytime you need your money, and it's going to give you those fixed returns over a long period of time or even in the short term. Popular companies like Capital One, Sophie, Upgrade, and Customers Bank offer you juicy amounts of return for your high yield savings account. And so if you have money that's laying down in your normal account and are not settled, or you're not decided about the kind of investment instrument you want to go in, then you might as well consider opening a high yield savings account, which allows you to invest your money and get some returns in the long term or in the short term, while you are making a decision for which long-term investment portfolio you want to go into. The last investment instrument will be the short-term certificates of deposit. So the short-term certificate of deposit is more like an investment that you put in an agreed amount of money over an agreed period of time, which means that you cannot access your money before that agreed period of time without a penalty. So let's say you have $50,000, you can put that $50,000 into a certificate of deposit account, and you want to leave the account for a 5-year period, and then they will agree to give you, let's say, a 10% per annum on that amount. If you decide to take the money before the 5-year period, you are going to get a penalty. But if you hold on until the 5 years, you are going to get that amount of interest that was promised you. It's more like what is called a fixed deposit in Ghana and some other parts of the world. Your money is secured up to about $250,000 if you invested in a bank that is secured by the state. And so let me add that there are other investment opportunities like stocks and forex markets and all of that, but those ones are quite risky, and I do not generally advise people who are not risk averse or who are not very competent in those markets to venture into those fields, because the wealthiest investors are those who have invested in instruments that guarantee the security of their principal or their initial deposits. Like George Clason said in his book The Richest Man in Babylon, the wisest investments are the ones that guarantee the security of your deposits. And so if you are considering investing, focus on these ones which are regarded as safe but give you a slow burn approach to building your wealth over a long period of time. I hope this video has been of value to you. Consider leaving a comment and let me know what you make of it. Thanks for watching, and I'll catch you in the next video.